So, continuing with the lecture, the next step in the accounting recording process is journalizing. Keeping a journal is what most people use in the recording process, and as I said earlier, it is referred to as the book of original entry. And the journal shows the debit and the credit effects on specific accounts. So the journal makes the following contributions to the recording process. It discloses in one place the complete effects of a transaction. It provides a chronological record of transactions, and it helps prevent or locate errors because the debit and the credit amounts for each entry can be easily compared. Okay, and so let me put this in the slideshow. This visual shows a complete journal entry, just as down here. You have the date of the transaction, the account titles, and the amounts to be debited and credited. And one thing you notice is that the first line is not indented. This is the first transaction here for equipment. But the second line is indented, the line for cash. When you journalize, you will always enter the debit first. Remember, you will determine which one, depending on which account you're dealing with, if it's a debit or a credit. Every time you journalize, the first line should be what you are debiting first, which is not indented, and the second line will always be the credit line, which is indented. Okay. After each transaction, you would add a brief description, which is right here in parentheses. And this brief explanation will include clear information that will inform the accountant what the transaction was for. Then, of course, you have the debit and the credit columns. So, in summary, the journal is a place to record all transactions in the business in chronological order. Okay. Now, from the general journal, this is the general journal, another visual. This is for September 1st, and notice that there's a debit for cash first, and then a credit for owner's capital, and you know that is a credit because it's indented. From the general journal, we then transfer the journal entries to the ledger accounts, and these bottom ones are the ledger accounts. This is called posting. And this visual clearly shows how to transfer a general entry to the ledger. Basically, what you are doing is separating the transactions and posting them in the appropriate account, whether it's cash or liability. In this case, it's cash and owner's capital. Okay, one extra component of the ledger is a column for balance. Okay, and basically what you're going to be doing is for each line that you post here in the ledger, you're going to find what that balance is. Whether it's adding cash into your account, that you put what that balance is. If you're going to be deleting money from or taking out cash from your account, then you're going to put it in as a credit, and let's say it's $2,000, then your new balance is going to be $13,000, and so on. Okay, so let's put all this information into perspective. From this visual, we can see what we learned in Chapter 1. We have a description of a transaction that needs to be recorded. It says that the asset cash increases $10,000 in owner's equity. Here's a transaction. I'm reading the basic analysis. On October 1st, this company invests $10,000 in cash in an advertisement company called Pioneer Advertising. So that's our transaction that they give us a description for. Then we analyze the transaction to determine which two accounts are affected. Remember, we need to affect at least two accounts. In this case, it's determined that the cash is increased by $10,000 and owner's equity is increased by $10,000. Okay? When we then record these transactions in tabular form, and you did that in Chapter 1 with the Excel sheet. Okay? And it's in reference to the accounting equation. Remember, it was cash is under assets and owner's capital is under owner's equity. Now the next step is to complete the debit credit analysis by following the debit credit rules. Okay? Once that is determined, you journalize the transaction. Here's a journal. And lastly, you will post it in the ledger with the corresponding accounts. Okay? That's basically what you're going to be doing this whole entire chapter. This visual shows you what the general journal looks like. Think of this as your checking account statement that you receive every month. The statement for your checking account records all of the transactions you made within the month, correct? You paid bills, you deposited money, you took out money. Same concept here, except you record the accounts that are affected by the transactions, and you determine if there are going to be debits or credits according to the debit credit rules. So in this case, it shows that on April 1st, supplies were purchased for $5,000, and accounts payable will tell you that you paid it using a credit card on account. So this transaction here, you say that it's for buying supplies on account. Okay. Now, and then on April 30th, you decided to pay the credit card balance by $3,000. So you paid it in cash. So this is the two accounts that are affected. You debit accounts payable for $3,000, and you credit cash for $3,000. And that's to pay charges on account. And you continue that with the journal. Every time that there's a transaction, you record it in one journal in chronological order, remember. Okay, now this visual shows you what a general ledger looks like. Let's go back to the checking account statement. Pretend that you would like to know how you spent your money on a particular month. You want to know how much money you spent on food, how much you spent on gas, how much you spent on clothes, etc. Well, think of the general journal as the statement that separates the transactions based on each account within the accounting equation. So you're going to separate all the stuff that you have here in the general journal by accounts. Okay, you're going to have your supplies accounts, your accounts payable, and your cash. And any transaction that affects each of these accounts, you will separate it in the ledger according to the date in chronological order. Okay. Along with this information, you have to have a balance column, which states the balance of each account after each transaction. Okay, so in here, on April 1st, you charged supplies on your credit card. So you credited $5,000. Your balance was $5,000 on April 1st. But on April 30th, you decided to make a payment to the account for $3,000. So you debited $3,000. So now your new balance on that account is $2,000. And this is what the $2,000 represents. So how do you know if you recorded everything correctly? One way to check is by completing a trial balance. This is what a trial balance looks like. And basically what this is a list of accounts with the balances that you determined over in your general ledger. You see how you have supplies account 5,000, your accounts payable is 2,000, and your cash is 7,000. All you do is transfer it to your trial balance. So basically what this is a list of accounts with the balances, and the balances will be recorded on either the debit or the credit side, depending if there's a debit or credit balance. Remember that a debit balance is when the total of debits, the total of debit amounts exceed the credits, and likewise a credit balance is when the credit amounts exceed the debits. Okay, so what you do is to list each account with the balance on either the debit or the credit side, and then find the totals for each column. You will know that everything is done correctly if the debit column is equal to the credit column. But just please note that the trial balance is only a checkpoint, and there will be instances where the debit side and the credit side will equal, but it will still be incorrect. This may happen if a transaction is not journalized, or when a correct journal entry is not posted, or when a journal entry is posted twice, or when incorrect amounts are posted.